All right, I guess we'll kick it off. This is our panel here. I think we're very happy and lucky to have both the sell side and buy side represented. Christine McNerney, McNerney is from Periscope Capital. Vic is from Meteora Capital, and Matt McCluskey is at iBankers. So I guess my first observation is I think focusing on the word new investor outreach is perhaps a bit of a misnomer. I think ultimately there's too much focus put on who the investor is in the list. Ultimately, when a deal is compelling, they will find a home. And so really, new investor outreach should be thought of as investor outreach. I think that I was going to rattle off some statistics, but I think it's safe to say that the IPO market is back, but the de-SPAC market hasn't really taken off to certainly the same degree. Obviously, that's not surprising because those new SPACs really haven't had a chance to go through the process, but we're still dealing with redemption levels that are very high historically, and right now only about a quarter of deals are trading above trust. So I guess to start it off, I'd love to get everyone's view on sort of what makes for a good target. What have we learned in the last cycle that would inform and perhaps change that opinion?
I can start. Is my microphone on? Yes.
Yes.
Okay. The thing that I really like to see when a sponsor team comes back in the de-SPAC market is if they found a target in the sector they said they were going to look in. Something really unique and special about the SPAC product is that the sponsor team should be able to provide value on the de-SPAC side. So, if you have all your experience in healthcare and all your connections in healthcare and you go and you find crypto, it's not wrong, but you lose some of that advantage. So that's always something that I like to see. The other thing that I think really makes a strong target is if they have clear projections and actionable outcomes that they're working towards, and if they're able to explain that to a financial market audience.
Vic?
No, I think that's well said. I'm a little distracted because we just got our pipe allocation call on a Cohen Capital Market one, and I'm looking for Brandon Sun, and unhappy, but I can strangle him. I don't know where he is, but there's interesting pockets in the market, and that was literally, I just got the phone call like 10 minutes before, and it's a 3 times oversubscribed book in the Bitcoin treasury space. And so they're upsizing a piece of the book and downsizing another piece of the debt piece. And so on some level, when you have the right people around the table, you have sponsors that understand what they're doing, that have the relevant pedigree and expertise. They're paired with the right capital markets and banking partners for what they're doing. And then the operating company or the asset on the other side have the right individuals for the story. That's where the magic happens. And yes, there's a degree of momentum to what we're all doing here. It's going where the puck, whatever the old Wayne Gretzky line is you go where the puck's going, not where it is today. And we're seeing a lot of investor interest. We're seeing a lot of sponsor interest. We're seeing a lot of operating company interest in emerging technology again, or digital assets, quantum computing, things of that sort. And ultimately, the individuals and purveyors who are sitting on the sponsor side that have been in these ecosystems, have built their careers in these ecosystems, are the ones that we view as the ultimate winners of this cycle.
Matt, what sort of a deal makes you breathe a sigh of relief and say, I'm glad to be working on this one?
Yeah, well, when we look at the target, I love to see a target that has established financials, has been around for a while. We want them to have a clear and reasonable desire to go public. Why are they going public? Is it to raise capital? Is it to implement a roll-up strategy? So long as they have a clear strategy or a reason as to why they want to go public is important. And then public company readiness. Where are they in their audit status? How are they? How are they doing compared to their peers fundamentally? And Christine hit on a great topic, which is having clear projections that they can justify and point investors to. I think that is super important for SPACs because it's one of the clear advantages that SPACs have to traditional IPOs. If you can point to those projections and investors can get comfortable with them, it's a significant advantage in the process. So those are a number of the things that we look for, among other things. But those, I'd say, are paramount for when we're looking at a deal.
So from my perspective, and echoing some of the thoughts that you just shared, I think there's an element that's really important, which is the philosophical one, right? Which is the management team aware and ready to embrace public company life? Because I think too many targets and perhaps even sponsors think of these things as a transaction that you sort of walk away from. And in fact, this is bringing a company public. It's a permanent capital vehicle. It needs to have a thesis. It needs to be marketed effectively. And there has to be an ongoing level of investor engagement because ultimately what drives that new investor, that turnover of investors from the yield SPAC investor to Fidelity, that's not zero to Fidelity. It's several turnovers in the shareholder base, and the earlier shareholders need to understand that there's going to be a buyer for those shares, right? So everyone has to sort of work towards getting sell-side coverage, thinking about passive money flows and how to get into indices and so on. And again, this is a process of growing. It's not overnight. But the management team has to show that they are committed to and aware of that process. And as you said, I think it's very important to think about what is the added value of going public through a SPAC, and does that exceed the cost of doing it, right? That's a very common sense sort of question that should be asked in de-SPAC transactions. It's not a financing mechanism. It's giving birth to a public company. All right, so now that we've identified our target, I guess, the marketing, from everyone's perspective, what makes a management team stand out both positively and negatively when they do one of the 500 meetings you take?
I can start. Hot tip for everybody, it's really easy to market a target if it's a good target, so start there. But aside from that, one of the things that I really look for in these meetings is enthusiasm. I think you'd probably be surprised to know how many times I'm sitting in this meeting where a sponsor team's pitching their target company to me, and everybody just seems very unsure that this is the right path, not very enthusiastic about taking this company public at all. And, if that's the way you feel, why are you doing this at all? I think that it's really easy to lose sight of the fact that a de-SPAC is the beginning of this company. It's not the end of the SPAC. So, you need to have that momentum going forward. And I always feel like that bodes well for how they're going to continue their marketing push.
I think the thing I would add from where we look from a diligence perspective is who's the CFO? Is there that senior leadership team, to your point, Mark, that will carry confidence into the public markets, that the numbers will be met, there'll be a beat and raise. That was the one advice. We had a SPAC a few years ago, GSR2 Meteora, and that was the most central point of the whole discussion. The founder was in his late 20s. He had built a phenomenal business in the digital asset ATM space. But he really needed that senior gray-haired leadership on his team, and he brought in Glenn Leibowitz to be his CFO. And I think that helped tremendously with that transition to the public markets versus typically private companies. They may not even have a dedicated CFO as part of their team because you don't really need a public company CFO as a private company. And so making sure that transition from the private markets to the public markets is seamless. The operator, the founder can continue to focus on what they do best, which is building. And they have people around them that can handle investor relations. They have the right capital markets partners. You have the right banking partners that can bring institutional research coverage, can get you in front of the right funds going forward. And so that's the critical pieces of the SPAC process that oftentimes get forgotten by sponsors as to, there's a whole, it's like it takes a village to raise a child. It takes a village to kind of get these companies public. And then it also takes a village to have these companies grow and thrive in the public markets. And over the last cycle, I think that was the part that was missing, was that there wasn't that emphasis and focus. I think someone had mentioned that people feel like the SPAC IPO is where you ring the bell and that's your successful outcome. It's really the start of the journey, or it's an interim step in the journey, as opposed to, obviously a very proud moment and positive moment for everyone involved, but it's certainly not the final goal. And I think to some extent that was lost a little bit on some of the parties involved in going public, these SPACs, over this last cycle.
Matt, what sort of management teams frustrate you as you try to market them, and why?
Well, I was going to say, Christine and Vic are definitely better suited to answer these questions because they're actually making the decision. They're pulling the trigger on the investments. I get excited about a team that can lay out a clear, concise plan and be able to articulate that to investors. And a lot of the things that the teams that Vic and Christine have already mentioned, having some sort of PR strategy, making sure that you're going to have sell-side coverage, having reasons for investors to continue to engage with you post the closing of the de-SPAC. Because you're really, that initial 3 months before you report your first quarterly results, there's a dearth of information there. So I think it's really important to have some sort of plan post-closing to show investors, just the amount of progress you've made, where things are going, just to continue to keep that communication open with as many investors as possible. I look at some of the teams that are frustrating. It's teams that don't have the capability to lay out their plans. If they have some experience in the past, they've had some success in the past, that's helpful. But at the same time, you want to be able to really explain why this time you're going to have success. You can't sit back and rely on what you've done in the past. It's really important to make the pitch and show that you're really, really ready to be a public company again, and ideally one that investors will be excited about.
And I think that a lot of SPACs, when they de-SPAC, they're in the news, you hear about them, and then the information kind of tapers off. And you're right, you don't hear much again until they start reporting earnings. And I think that, you don't want to become an orphan out in the market. So it's really important to make sure that you're continuing to be out there and generating buzz and adding information. And, I do think that that's an area that's not being developed as much as it should be.
So this is a favorite topic of mine, so I'm going to mention two things, right? The first is management teams that, want to try out an aspirational valuation and go talk to some investors, right? And, Christine's always very nice, Vic's always very nice to take the meeting. And then I say, well, so what do you think? Like, where are you willing to buy it, right? And the truth is that we shouldn't ask investors to do that work when they don't know whether that results in a multiple that somebody's willing to transact on, right? So this exercise of testing the market with valuations and hoping somebody tells you what you should be doing is something that really I would strongly advise you to avoid. I don't know if you guys agree, but the second thing is, again, kind of going back to this public company thing, I get a lot of management teams that kind of come in with a presentation that's a corporate presentation, right? They tell you, the history and the management team and the products and the market and this, that, and the other thing. And ultimately, I think it doesn't matter, right? Because, you can be selling widgets. What matters is that you can articulate why the stock's going to go up. And I think that means that you have to think beyond revenue multiples or EBITDA multiples, or going back to a dated reference, eyeball multiples. You really have to go into, free cash flow yields, capital allocation, ROIC, and it's not a process of dictating what you want investors to think your 2028 results are going to be, because they're always going to treat that with a grain of salt, but really empower them to understand how your model works so they can make their own assumptions and can understand that you understand how to drive the business and the value of the stock, and they have a way to grade you. So that transition of thinking how you present yourself is really critical to work through. So, another observation is I think a lot of the ecosystem is very views SPACs as a discrete transaction as opposed to sort of this longer term process. How do you see that in your experience talking to SPACs, and what's your recipe in terms of how to change that?
Like linking performance longer term, or just incentivizing people to be more involved?
Well, I don't know. How do you? That's what I'm asking you, right?
Okay.
Which is how do you get people to think about this is not a transaction from which I move on. I raise my next SPAC. I have my financing. I kind of go dark on an investor relations front. How do you avoid that? How do you encourage teams and targets to really embrace this longer term view?
I mean, I think that we need, and we've talked about this before, and I've probably talked about it with a lot of people here, a modification to the structure that incentivizes the sponsor teams to stay involved and to find really solid targets and have appropriate valuations on the front end, and then to continue to work with them in the long term. Like, I feel like the current structure right now, there's a huge incentive to do your transaction, you're done, move on to the next one, you've made your money, and that's great, and who cares what happens to it afterwards. And like, from an investor perspective, that's not the most enticing proposition I've heard. There's other things that we can put our money into. I want to see that you guys are going to stay involved and you're going to keep doing that. Serial SPAC sponsors have a bit of a leg up because in their story, there's part of the, I need this to do well because I want to keep doing SPACs. But if you're new to the table, it's going to be tougher to convince people that you're going to stay involved with the structures in place the way they are.
And just naming it ABC SPAC number 1 doesn't necessarily mean that you become a serial SPAC sponsor.
Oh, yeah.
Any thoughts?
No, I would agree with Christine. I'm happy for sponsors to forfeit their promotes on all the ones that am not the sponsor on, so that's fine. But otherwise, yeah, I think alignment of incentives. I think the SPAC product as well is not well understood by, folks outside of this tent a little bit. And, we struggle even with our institutional clients that have allocated money to us in the space for decades. They don't understand the product that well. I think as a group, as investors in the space, as sponsors, service providers, bankers, lawyers, et cetera, I think the press narrative has been unfairly skewed in the wrong direction. Like, for better or worse, these Andrew Ross Sorkin types on CNBC and others, they seem to still not understand the product as well. Like, I think it wasn't that long ago when Anthony Pompliano raised his SPAC, and he was on CNBC in the morning, and like Andrew Ross Sorkin's asking him the stupidest questions. Like, it's literally on the cover page of the IPO prospectus. Like why do you have to spend of a 5-minute interview like 2 of the 5 minutes grilling the guy on stuff that everyone should know? And so there's a little bit of that investor education process and the demystifying of SPACs. I think they're somewhat understood, but there's just elements for some reason that make it feel like it's advanced calculus or something to participants in the market that aren't daily participants. Like yesterday, I was in the office of one of the larger public digital currency funds, digital asset funds, and they have a token business, a staking business that they're getting calls every day from sponsors and others. And he's like, just explain this thing to me. I don't understand what a SPAC is. Right? And it's like, and so that to me I found odd because the guy's like a 20-year RMBS, his prior life was a 20-year RMBS guy. And so I'm like, it's not that complicated, but apparently it is, right? And this guy's like talking about what he's going to do with his like business that he's put his blood, sweat, and tears into for 5 years, and he doesn't understand what the other side is. And so I think that part, I don't know how better to demystify it. I think a lot of companies and sponsors think the trust is like guaranteed money, right? Like that's like a simple thing that, no, you need to set the valuation conservatively. You need to leave some chips on the table to entice the investors to stay in. And like things like that, I think those are difficult conversations that sometimes, you know, sponsors do not want to have with targets, and because you want to get a deal done and you want to get a deal announced, and those are the challenges with the product. It's you know, Neil Shah, who was, you know, at Citi and Evercore for a long while in the space, he used to say it's 3D chess, because you've got this blind pool of capital, and you're trying to convince a company that this is the right way to execute their IPO and their exit strategy. So that's
So
the challenge I think we're trying to solve.
The more legitimate de-SPAC transactions we have that perform well, the more this problem will solve itself.
Exactly.
So like that's what we need to have happen. So that's for everybody in the room. Go get that done. And you know, we won't have the boneheaded questions on the news. Like people will understand the product because they'll be more familiar with it, and it will feel like a more legitimate way to IPO.
And I think, adding to Christy's point, the serial sponsors, in your earlier point, there's a depth of experience, pedigree, and knowledge of what they're doing and how to successfully navigate the capital markets aspects of this. And you know, obviously, the banks in the space have decades of experience. You know, with your two firms and you know the other banks that are dedicated to the product, and so the capital markets bankers, the M&A bankers, understand how to utilize the tool, because it really, my view has always been SPACs are a vehicle. They're another. It's not a distinct asset class. It's not this or that. It's another way for operating companies to access the public markets. It's competitive to a regular way IPO. It's competitive to direct listings. It's competitive to reverse takeovers or RTOs. It's competitive to OTC uplistings. And so it's just a matter of making sure that the product fits the value proposition for the operating company, in that it solves whatever unmet need that they have in going public.
And so just rewatching Ted Lasso, I just want to echo Christine's comment that every SPAC cycle really kicks off with a compelling transaction, and investors are goldfish, right? They'll come back if it's working. So
We're the investors.
I'm sorry?
We're the investors, not a goldfish.
Well, the broader group of investors that you need to make this work, right? You know, let's just move to pipes. It was something that was touched on earlier. What's your view on you know, the use of pipes and how they're done properly, et cetera? Maybe I'll start with you, Matt, just to break it up.
Yeah, ideally, you're going to have you know, any pipe that's involved, you're going to want it to be at $10, right? $10 equity, no discount, no bells and whistles. Someone committing to an investment even before you announce the BCA. So you get the subscription agreements in place. Would be great to have a well-known name that's willing to advertise their investment, or a strategic investor is ideal. But that's not always what we see. I think that the deals that we have seen that have had the most success have had some element of that to their pipes, to their financing. You know, we always like to have that pipe because it increases the likelihood that your redemption rates are going to be significantly lower. The redemption scenarios become somewhat binary, where you know, if you have the financing in place and people are excited about the deal and the deal's trading higher, the level of redemptions is going to be significantly low. It's going to be quite low compared to if you don't have the financing in place and there's some uncertainty around the deal closing. And if the stock's not moving, you're going to have 95 to 99% redemptions. I've actually even seen 99.3% redemptions in some deals. So, the quality of the pipe is important. If you get to the point where that's not an option, one of the things we like about targets, and we touched on it earlier, is if the target has established financials and their past is well documented, you can see that there's significant revenue generation, they're EBITDA positive or maybe on the verge of being EBITDA positive, then I think you have other potential options for you. Some sort of debt financing or convert financing is a potential path to get financing for that company. And then there's always non-redemption agreements, et cetera. But I think that the ideal scenario is to have some sort of well-known investor or strategic investor that's willing to invest at the deal valuation. A slight discount is still acceptable, but I think you want to avoid anything that comes at 50, 60% discount to the actual deal price.
No, I don't have much to add. I think Matt summed it up perfectly in that for the broader institutional base and the public investors that own the SPAC shares, to see that validation from either a sector investor leader that has significant mind share as a top shareholder of other public companies in the space, or a strategic that has a real rationale for backing that asset or that story in the public markets, that's 90% of the way there to having a solid kind of bulletproof deal, and minimizes closing risk and execution risk, funding risk, and all of those things. And I think that was even, Mark, to what you mentioned initially, like having a validated deal where the valuation makes sense and previewing the deal, not trying to come to market at 3 times where comparable assets are valued. If you can have that validation ahead of time before it's publicly announced, that almost ensures that you'll keep your trust.
Well covered, Christina, or would you like to add something?
I'd say it's pretty much well covered. The only thing I would add is, in the instance where we don't have this ideal scenario, which is obviously what everybody wants, and we are trying these structured products, I don't think that the market has found a balance yet of providing the structure and the floor to offering something that really screws the company once it's public. And, as an investor, we need to find that fine line and that balance. And, I'm always more enticed by a pipe that does have, less flaky capital already committed. So, we need to find that balance and that mix, and I don't think that we're there yet.
So you're saying that if you're trying to sell an equity solution, a go public solution, your capital should be equity?
Ideally.
Yeah. So I would add something that's maybe a little bit contrarian, right? Which is to say, I think that if you go back to the before times, pipes really didn't figure into the de-SPAC process, and the reason why is because the whole idea here is that you bring a deal that's compelling, right? That has a good valuation, that has a management team with a story that it markets well. And then the shares trade above trust. And that shareholder turnover happens, and ultimately you end up with a new investor, right? Why is that important? Because if you go to an investor and you say, hey, I have this idea for you, the first thing they'll do, as you're talking to them, is type into their Bloomberg the ticker symbol, and they'll look at whether it's trading above trust, and they'll look at what the volume is, right? And the problem is that if you use a pipe, then that initial fundamental interest is diverted out of the common publicly traded shares that can validate your deal to everyone, not just people who are on the marketing process, but retail investors as well. You can see that there's momentum building, and that's really what validates the deal. So, in my view, pipes have a place if it's to gross up the proceeds on an unpromoted basis, which is good for the company. Or, to your point, if you are finding dollar one with a related validating investor, be it from the sponsor side or the industry side, where it does send that valuation signal that's missing if you don't have the natural turnover in the public stock. I think it's really hard to go and raise dollar one in a pipe from a third-party investor outreach. So I keep that in mind. I guess, what's your favorite misconception that you would like to set straight about SPACs?
I would say that I think there's a common belief in a lot of the investment community, so probably not the people here, that SPACs are a way for really bad companies to go public. And of course, we have seen some of that, but that's not what the product's supposed to be. And there have been some really excellent transactions that have happened and we hope will continue to happen. So, part of that is we just need these bad transactions to fade into the memory, but it's also, that's not the way the product's been designed, and I do think that that is something that a lot of people think, that is what this is for, to take a bad company public.
And to echo Vic's earlier point, the way that's discussed in the press is also very misleading, right? Because if you have 99.3% redemptions and the stock goes to $2, then who really was hurt? What massive capital destruction was there from that transaction? So yes, it happens. But nobody's forced into participating in those deals, and that's that optionality that's given to the investor community is really what enables companies to rise up and do well with the process.
I mean, that really is the biggest item. I think when you look at it, right, the initial conversation that sponsor teams are having with targets now has basically evolved from what is a SPAC, having to explain what a SPAC is and how it could work for your company to come public, to now the initial conversation is, all right, you've heard this about SPACs, but a lot of this is not true. Some of it is, and just working through all the points that the media or those that don't know the product as well as everyone here does, kind of create these misconceptions, and you just have to educate the target as to why a SPAC could be a good thing, and that's going to come with time and quality deals. And then I think when you look at the part of the media pitch is that it's a way for sponsors to get rich. It's not necessarily the best thing for a company to go public via SPAC, but it's great for sponsors. Well, that's not always the case. In most instances, it isn't. I do believe that investor interests and sponsor interests are aligned with the company's interests as well. And the more deals we see where all interests are aligned and things are moving in the right direction, the reputation around SPACs will continue to improve. And I think we've seen a couple deals earlier this year, a couple last year that investors got excited about. And ideally, with the number of SPACs we have in the marketplace right now, we'll continue to see higher quality deals getting done, and a lot of those misconceptions will be a thing of the past.
So I'll jump in and say I think one of the misconceptions that I'd really point out is that bigger is better in SPACs. If you think about the biggest obstacle to a successful SPAC transaction as being the perceived free lunch of the sponsor, the way to handle that is to have a target that is 5x or more larger, because then your pro forma ownership as a sponsor is low single digits, which is very acceptable, particularly if, as to Christine's point, it's a sponsor team that is valued by the target for an ongoing relationship, mentorship, industry expertise, whatever it is that they can do to accelerate the business plan of this new company. And I'll just mention that if you look at the top performing SPACs in terms of cumulative common share return, of the 5 largest, 3 of them are $40 million SPACs that have de-SPAC targets that are now worth billions of market cap. You have one $690 million one and one $250 million one. So bigger is not always better.
I would add, Mark, to your one point on the misconception. I forgot about this, that every investor has the right to redeem, right? You've got audited financials. Investors have the opportunity, they're welcome, they're encouraged to meet management. The do the diligence that you, more so diligence than you got to do than a regular way IPO, which is like condensed over a week period. And you don't get to explore a financial model. You know, it's a desk analyst sharing a model from the lead underwriting bank. Here, investors have a 3-4 month window to do a deep dive on the company, and ultimately investors vote with their feet. And so I think that's why litigation risk is so low in the product, is because unless you're committing outright fraud, which I think there's been, you know, out of the 700-800 SPACs the last 3 years, is 1 or 2 that have fit in that category. It's a product where every investor has had the opportunity to review it in great detail and make an informed decision whether they want their $10 back or whether they believe in the company, their projections, their valuation. And you know, with the projections and other things, there's a wealth of information that if investors are willing to do the work, they have every opportunity to make an informed decision. And I think that's been that's a huge positive of the product that you do not get in other areas of the capital markets.
Stated in a slightly different way, I think what's beautiful about the SPAC is that it's a democratic process. The IPO market is basically geared towards the top 50 investors by assets under management. They're getting fed a level of information and detail that's not available to the outside market. They're getting allocations based on their overall relationship with the underwriting firm. With a SPAC, the number 50 to 100 investor is perhaps the most important, right? And they can self-select. They can have access to the information. As Jim Graff always likes to say, it's good for more complex stories that actually require more weeks of marketing to really explain, more follow-up meetings, as opposed to, hey, our analyst says this thing's going to do $2 in EPS next year. What's your indication, right? So, last thought. As we wind up our time, thanks so much to the panel. Always a pleasure to see you, and it's nice to see you in person. And I guess thanks very much, guys.
Thank you. Thanks, Mark.
Thank you.